The single greatest concentration of wealth in stock market history is happening right now. And if you're invested in the S&P 500, you are dangerously exposed. Valuations have surpassed every historical bubble peak. Just 10 companies now make up a staggering 40% of the entire S&P 500. This isn't just a bubble, it's a tightly wound trap set to spring. Your financial survival depends on what you do next. Why does this data matter? Because history always rhymes. As expert Taylor Kenny from ITM Trading warns, the biggest danger during a bubble's mania phase is the widespread conviction that this time it's different. People refuse to acknowledge warning signs and dismiss historical precedents. They said it was different in 1929, in 2000, and in 2008. They were wrong. This isn't about company performance, it's about currency debasement. The illusion of wealth created by endless money printing. These record valuations are a symptom of a dying dollar, not a thriving economy. When this house of cards falls, the mainstream narrative will evaporate, and only real, tangible assets will stand. Let's look at the hard data. The price-to-book ratio of the S&P 500 is now at record highs, exceeding even the lunacy of the dot-com era. This metric measures price against actual asset value. The numbers are screaming that stocks are dangerously detached from reality. This isn't opinion, it's mathematical fact. So what does this mean for precious metals? It means rocket fuel. When, not if, this concentration unravels, the tidal wave of capital fleeing speculative tech stocks will seek a safe harbor. History shows us this massive flight to safety is the primary catalyst for monumental rallies in gold and silver. Physical metal is the ultimate antidote to a poisoned market. This leads to your two actionable strategies. First, for preservation, immediately reevaluate your portfolio. If you're overexposed to index funds or speculative growth stocks, it's time to diversify into physical gold and silver. This is non-negotiable for wealth protection. Your second option is for opportunity. This massive systemic risk primes the mining sector for a historic catch-up rally. Consider allocating a portion of capital to a reputable miners ETF like GDX or GDXJ. A crucial reminder, only use trusted, reputable dealers for your physical metal. So I put the question to you, the prudent investor. Based on this data, what is your strategic move? Will you be fortifying your foundation with more physical bullion to weather the storm, or will you position yourself for aggressive growth in the undervalued mining sector? Let me know your philosophy in the comments below. If you believe in protecting your hard-earned wealth from a rigged system, subscribe now. We provide the data-driven analysis you need to stay ahead of the collapse.